As a high-yield investor, one of the worst things you can experience is a dividend cut. Specifically with investments that come with double-digit yields, it's rare that these investments can offer consistent dividend increases. As a result, when these investments reduce their dividends, it can take many years for the possibility of them to regrow it. In many cases, when a dividend cut occurs on these investments, they never recover. There's several reasons why a company or a fund will cut their dividend, but it's usually due to financial hardships. But a dividend can also be cut for an alternative reason, even when it's not entirely necessary. Last week, the company PIMCO announced that they'd be reducing the dividends for two of their closed-end funds, one of which I own. The first cut was on their Strategic Income Fund, ticker RCS, which they reduced by 21.6%. The second cut happened on the PCM Fund, ticker PCM. Although their dividend was only reduced by 1.5 cents, it was still a 19% reduction in their monthly distribution rate. I've been a shareholder of PCM because I was a fan of how dependable its dividend distributions have been throughout its history. The last time this fund went through a dividend cut was almost 18 years ago, back in 2007. I've been pretty fortunate. Given the high-yielding investments that I hold, dividend cuts don't happen to me very often. But what's even worse is when a company or a fund decides to cut its dividend when it's not entirely necessary, which after looking at all the evidence, I'm convinced is what's happened with PCM. Based on the metrics I'm seeing, I'm convinced that PIMCO could have kept this fund's dividend at 8 cents per share per month, but they willingly chose to cut it for an alternative reason. In this video, I'll show the evidence I found that points to this dividend cut being unnecessary. I'll also give my opinion as to what I think we can expect from PCM in the future, and if I think it's still worth holding on to, or if I think it's a good idea to sell it. This graph shows every dividend payment made by PCM. You can see throughout its history, which goes all the way back to the early 90s, this fund has only cut its dividend one time. And the reason for that was because of the financial crisis, which was unfortunate but understandable. The financial world was on the brink of collapse. They did raise their dividend by a penny a few years later, but PCM's dividend had remained the same for a very long time after that, until just recently. Fortunately, it is very rare for one of these funds to go through any kind of dividend cut, which is good. So what evidence exists that points to this dividend cut being unnecessary? There's a few places we'll want to look into. In the case of closed-end funds, it's a good idea to look at their dividend histories, more specifically the source of each dividend. If you're not too familiar, the dividends paid by CEFs can come from 4 different sources. They can be interest income, short-term capital gains, long-term capital gains, and return of capital. Every monthly or quarterly dividend paid by a CEF can have a mixture of different sources in it. It's not a rare thing to see. In this example, looking at the Cohen & Steers Infrastructure Fund, it pays a consistent dividend of 15.5 cents a month. Sometimes the source of these dividends is interest income, which is the interest earned from the fixed assets held inside the fund, and also short and long-term capital gains, which are profits earned from the fund managers selling positions inside the fund for a profit, and ROC. Return of capital, in the majority of situations with closed-end funds, is money from the fund's capital. If a closed-end fund doesn't want to cut its dividend and it's not earning enough money, then they can use some of the money that's already been invested in the fund to keep the dividend at its current rate. I've explained in previous videos that ROC doesn't necessarily mean a fund is using what's in their NAV to pay dividends. ROC is ultimately a tax classification, and funds are allowed to classify some distributions as ROC if it meets certain requirements. For example, funds that generate income through derivatives or other intricate option strategies are sometimes allowed to classify their dividends as ROC, but this usually involves ETFs that use some kind of covered call strategy and not closed-end funds. If a closed-end fund is in fact paying from its NAV and it's doing this way too often and for a very long time, it'll eventually cause the NAV to shrink. So if you see a closed-end fund relying on a lot of ROC for its dividends for a very long time, that's usually a bad sign. It's usually inevitable that a dividend cut will happen if they can't turn things around, because the fund will just be eating itself. A good example we'll look at where this happened was RA, the Brookfield Real Assets Income Fund. The CEF suffered a dividend cut in 2023, and leading up to it, you can see that ROC was making up a majority of each month's dividends. Some months ROC was making up almost 75% of its payments, and this is something that went on for many years with this fund. So let's look at PCM's dividend classifications over the past 5 years. In the majority of months, ROC wasn't even used, which is interesting. There was an uptick in the usage of ROC starting in 2024, but the amount of ROC only made up a very small percentage of their dividends. Compared to other funds I've seen, this kind of dividend history isn't something that would concern me. If I saw this for the first time, I wouldn't be worried. But this isn't even the most convincing piece of evidence that PCM's dividend could have been sustained. The next thing we'll need to look at is PIMCO's UNII report. UNII stands for Undistributed Net Investment Income, and it's a report that's unique to closed-end funds. The report shows how much beyond current earnings a closed-end fund has available to pay future distributions. Ideally, we want to see this number above 100%. If it's less than that, it's not necessarily a problem unless it's a common occurrence for them. What you also have to keep in mind is that most PIMCO funds report very low dividend coverage in the beginning and middle parts of the year, but when the year ends, we normally see a rapid increase in dividend coverage. So if you try looking at this report in February or March and you see that these funds' dividends are only, say, 47% covered, it'll likely cause some unnecessary anxiety for you. As of the making of this video, PIMCO only has their November report up, which only displays their dividend coverage from January 1st to November 30th of last year, so we don't yet know how well they did in December. But this is every closed-end fund offered by PIMCO. In the last 3 months, PCM's dividend was 102.79% covered. This is an excellent sign that, again, PCM's dividend coverage was rapidly increasing at the end of the year, which is what always happens. We can see as of November 30th of 2024, their year-to-date coverage was 90.15%. Again, less than 100%, but it was rapidly increasing. Here's the key thing that needs to be pointed out. Out of the 20 closed-end funds currently offered by PIMCO, 10 of them were reporting worse dividend coverage than PCM. In other words, PCM's dividend was better covered than 10 other funds offered by this company, and none of those 10 other funds went through a dividend cut, only PCM and RCS did. I've tried to find an explanation as to why a cut was 100% necessary, but I can't come up with a good explanation. This is PNF, another closed-end fund offered by PIMCO that was only reporting 75% dividend coverage. And as we can see, no dividend cut. This was exactly the same case for 9 other funds. So what then could explain PIMCO's reasoning for cutting PCM's dividend? Closed-end funds don't have earnings calls that we can listen to or anything similar that would give us an explanation. I do have a theory that I think could make sense. Both PCM and especially RCS were trading at very high premiums. They were trading at the highest premiums out of all of their CEFs by a pretty big margin. Although a dramatic drop in their NAVs didn't take place before the dividend cuts, my belief is that PIMCO might have reduced the dividends on these CEFs to lower their premiums. A very high premium is very bad for a CEF as it makes it unappealing to a lot of investors and financial institutions. They knew a dividend cut would drop their share prices, thus significantly reducing their premiums. This is the only explanation I can come up with as I haven't found anything better. You might be wondering about PIMCO's other funds, such as PTY and especially PDI. PTY is currently trading at a very high premium, but this fund has also been better at growing its NAV, so I see that as an encouraging sign. They have used some ROC, but it's been a very small amount. PDI appears to be stable. No ROC is being reported in their dividends, and the premium it's trading for isn't close to what PCM used to be or PTY. So right now, I don't have any intention of dropping these funds from my portfolio. As for PCM, I think the likelihood of another dividend cut happening soon is unlikely. I haven't fully decided what I'll do with this fund yet, but I'm likely done buying shares of PCM. I have 2 options, and one of which is a really nice thing about high-yield investing. I could just hold on to it and reinvest the dividends, and eventually I will fully recover my investment. That's assuming PCM won't freefall in share price, which I don't see a reason to believe that it will. Unfortunately, if things don't get better moderately soon, the process will likely take many years. If we see interest rates high for a very long time, that'll likely slow down PCM's recovery. What I'm leaning towards is gradually selling my shares for tax loss harvesting. It's an unfortunate situation, and it reminds me of what happened to me and WP Carey. This stock had a 25-year dividend streak of increases, and everything was going very well. Then completely out of nowhere, they announced that they were dumping part of their portfolio and slashing their dividend. These kind of unpredictable events are painful, but there's nothing anyone could have done to see them coming. So in the end, I'm planning on slowly selling shares of PCM and putting them into other holdings. I can only speak for right now, but after that dividend cut, its massive premium is now gone. That would lead me to believe that PCM likely won't cut its dividend again for a very long time, and hopefully never. And again, I'm also not done with PIMCO funds in general. I'm still holding PDI and PTY, and I have no plan to sell those. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, Take care.